Thanks everybody for joining us today. Greatly appreciate it. We hope everybody's having a great summer so far, and we appreciate you taking the time to be with us today. We're very excited about today's topic, saving for the next generation. Trump accounts are set to launch on July 4th, and we have fielded many questions about these, along with 529 plans and other ways to help children, grandchildren, and other loved ones or friends with their education. Legacy planning, both while you're here and after you've passed on, has become increasingly important to many of our clients as well, especially as their financial wealth and capacity for generosity grows. So we are super excited to help people plan with this purpose in mind. I'm Mike Tarrant, founder and financial planner here at Tarrant Financial Advisors. And today, my colleague and associate advisor, Charlie Curry, will walk us through the ins and outs of saving for the next generation. Charlie entered the financial planning profession back in 2010 and joined Tarrant Financial Advisors in 2019. Many of you have gotten to know him and appreciate his financial planning, investment, and tax planning expertise, along with the care he takes with his work and all of our clients. Charlie has delved deeply into today's topic and will aim to help you wade through the information and the misinformation that's out there and bring clarity to the plans you may be making or may want to make in the future. A couple of housekeeping items. Compliance regulations, believe it or not, do not allow us to enable the chat feature in the webinar environment. So if you have a question, simply unmute your mic and hop right on in with your question. We will also have some Q&A time at the end of today's conversation. And respect of your time, we will aim to end promptly by 12:40. With that, Charlie, take it away.
Thank you very much. I think we started going on this, getting interested in this topic based on the interest in the Trump accounts and really people wanting to know, our clients and others wanting to know more about what they are, how they work, what are they really for. There was a lot of information going around last year, especially when there were different versions of that one big, beautiful bill act that were passed in the House and then the Senate, and really the rules got changed on a lot of things. So it was very difficult to get information initially, especially because of how much change there was in the regulations. So we thought this would be a good opportunity to go through all of that with you all and also talk a bit about really how these fit into like the overall picture when it comes to saving for the next generation, for your kids, your grandkids, nieces, nephews, all of that, and kind of compare the Trump accounts to what was already in place, like the 529 accounts, custodial accounts, etc. Before we get started, there's just a quick intro to our team. I know we know many of you. If there are any new faces out there, then that was Mike Tarrant, owner and founder of Tarrant Financial. I'm Charlie Curry, I'm a certified financial planner and enrolled agent. And Phoebe Mason is also joining us today. And the one is not with us because she is in a all-day conference is Liz Thomas, our customer service associate. So as I mentioned, we're going to get started talking about Trump accounts, 529 plans, and UTMA accounts. And let's start with just what are they? So essentially, I want you to think about a Trump account as an IRA for someone under 18 that does not have a earned income requirement. Normally and previously, whenever you had a child and you wanted to make an IRA contribution, they had to have some kind of work, a W-2, some kind of small business, something that have earned income to be able to make a contribution to an IRA or a Roth IRA. That's not the case with the Trump accounts. That's really one of the biggest features is that limitation is gone, although there are a few other stipulations that kind of come with it. So after age 18, however, it really just follows the traditional IRA rules. So if you're familiar with that, anything that's has a tax basis in it that comes out tax-free, anything that doesn't is taxable. There are premature withdrawal penalties when you're under age 59 and a half, and we'll go into all of that. But whatever you think about when you think of a traditional IRA, that's really how this is going to work after age 18. So first thing is they are available starting on July 4th this year. That date was just picked because that is the 250th anniversary of the Declaration of Independence. So they wanted to start it right on that day. The way you start one of these accounts, so there's really two ways. You could file the IRS form 4547 with your tax return. That could have been done last year. However, if you didn't do that, don't worry about it. TrumpAccounts.gov is where you go to sign up for it. There's a form in there, a process you can go through for funding it. One of the neat features about the Trump accounts too that you've probably heard about is that all children born in 2020, the calendar year 2025, 2026, 2027, and 2028 will get a $1,000 one-time pilot contribution from the U.S. government. So if anyone in your family was born in that time frame or will be born in that time frame up until the end of 2028, make sure to work with the parents to get an account open so that can be funded. I heard it's been said that anyone who doesn't open an account after a certain time period, one will be opened on their behalf, and then the $1,000 will be deposited at that time. But you might as well just go ahead and get it open sooner and get the money growing as quickly as you can. So, how do contributions work? They can be made on anyone by anyone on behalf of the child. They're not tax deductible. So if that's one thing to think about with a traditional IRA. You think, okay, I put money in, that's a tax deduction. However, there is a thing with a traditional IRA where there are situations where you can make an after-tax contribution and it's not deductible, but it carries that basis. That's how this is really going to work. It's a non-deductible contribution. Contributions are limited to $5,000 per year from all sources, except for that $1,000 pilot contribution. That doesn't count. That's extra on top of it. So if you're thinking you're coordinating with other members of the family to make a contribution for one particular child, it's $5,000 per year per child, not $5,000 from each parent or grandparent or whatnot. The after-tax contributions are tracked on the tax return. So that's one thing that to make sure that if you work with a CPA, EA, or another tax preparer, just make sure that they know that you've made that contribution. It'll be taxed on, or be tracked on the tax return. If you use TurboTax or something like that, just make sure that that's tracked as well. I strongly suspect they're going to have pop-up questions in all the tax preparation softwares coming this year where they're going to ask you, like, did you make a Trump account contribution? How much? But just keep that in mind. Maybe put a note in your tax file to check on that. There is an opportunity for employers to also make a contribution on behalf of the employee's children. That one is going to be pre-tax money, so it's not taxable when received, but does not carry that basis to make it tax-free later. And that's limited to $2,500 per employee, so not per child. However, that does count towards that $5,000 limit that we just talked about a moment ago. So contributions, they go in, they're tax deferred, so you don't have to pay capital gains on it while it's in there. It just grows tax deferred and it can be used later. And that use later is kind of has some stipulations that go along with it. So no withdrawals are permitted before age 18. So don't think about it as something that you would use for primary or secondary education. Any amounts that are over that tax basis are going to be ordinary income tax. So think like your growth on your contributions, or if you had one of those contributions from an employer, that's all subject to ordinary income tax. Withdrawals from age 18 to 59 and a half, they're subject to the IRA rules, like I mentioned earlier. So that's the 10% penalty unless an existing exception applies. Education is one of those good exceptions where you don't have to pay the 10% penalty if it's used for post-secondary education. However, the earnings is still taxable. There are also the hardship withdrawals. There $10,000 is available for a first-time home purchase, which frankly does very little to help you afford a first-time home, in my opinion, but it's there. And just like an IRA, there are going to be required distributions at the begin date, which is currently age 75 for anybody that was born after 1960. So obviously, anyone who's going to have a Trump account is going to be born after 1960. So that's going to be an age 75, where just like with your IRA and your 401k, you'll have to start taking a certain percentage out of it every year that goes up every year. One neat little thing too is these can be rolled over into one of these ABLE accounts. An ABLE account is an account that's set up for a disabled person. So there's certain requirements to be able to have a ABLE account, no pun intended there, but they center around disability. So if you have any questions about, if you have anybody that you know in your family or a friend that might be in that category, just let us know. We have to talk more through you about that. The rollover can only actually happen in the year the beneficiary turns 17, strangely enough. So there's a very narrow window of time there that you can do that. So what are the advantages to Trump account? So that $1,000 pilot contribution, obviously pretty good advantage. Again, anybody who's eligible for it based on their birth years should probably take advantage of that. It allows for the IRA contributions for kids who don't have earned income. So for very young kids, especially, that can be very hard to get earned income. So that's very helpful. There's opportunity for the pre-tax employer funding, and then the one of the things we like best about these is it can open the door for a very carefully planned Roth conversion after the child turns 18. So if you think your early years of adulthood, income might be lower than it is later. So there could be a Roth conversion performed on that account that might have a relatively low tax rate applied to it. But kiddie tax does apply if they're still dependent. So if they're in college, you're providing more than half of the support, then that could come back on to the parent's tax return if that's the case. So that's really what we mean by carefully plan. Number one, making sure that the income isn't going to be too high that it makes sense, and then number two, that we're not actually causing mom and dad a bunch of tax on accident. A few disadvantages. I wouldn't say this is a huge one, but the investments are not completely open architecture. They're very limited. Basically, they're gonna have a few low cost U.S. stock index funds they're gonna be available for investment while they're under 18. Once they're over 18, then it becomes portable and you can move it to other institutions. I just saw actually this week that it's gonna be BNY or Robinhood. They're kind of the same. They're working together to be the custodian for these assets. And then after age 18, you might be able to move them outside. You can definitely roll into an IRA after 18 and then take control over it. But whether you can keep it a Trump account and move it outside, I think that is yet to be determined. The taxable portion of withdrawals is ordinary income tax, as I mentioned, so that's a disadvantage. There's some other account vehicles that maybe make more sense for certain purposes, and we'll go into that in just a few minutes. There's no exemption from the tax on the growth like there is with a Roth IRA or a 529 plan when used for education. So that's kind of a downside too. And hearing that some states are actually planning to tax annual earnings. So those states so far that are doing that are listed there: California, Hawaii, Kentucky, Massachusetts, Pennsylvania, South Carolina, and Wisconsin. So if the beneficiary lives in any of those states, that doesn't necessarily mean don't do it in those states, but it definitely can make the one of the primary advantages a little less attractive depending on the state tax rate. So how does it measure up? We did a little report card. What is this best for and what is it bad at? Getting an early start for retirement, your Trump accounts are pretty good because it's really one of the only ways to do it unless the child has earned income. Saving for education, it doesn't stack up to some of the other options that are out there because the earnings are still taxable. And then using it for all the other stuff that isn't retirement education, you're going to have that not only income tax but the 10% penalty on those withdrawals. So it really becomes difficult to use it for those purposes. So we really see this working best for retirement, and with the flexibility of knowing you can use it for education as well if it was available and it was needed. So next we want to kind of compare this to 529 plans. How do the Trump accounts stack up to it? What are the 529 plans? I think a lot of people are probably more familiar with the 529 plans than the Trump accounts. We can kind of briefly go through how they work and what their advantages and disadvantages are too to see how they stack up. This is basically an account that behaves a lot like a Roth IRA if you use it for education. If you don't, then it kind of becomes it has some disadvantages to it. They are sponsored by state, so each state has their own 529 plan. There can be advantages to using it in a home state, but you're not required to use your home state's plan. If you live in Georgia, for instance, you can use the Rhode Island plan or the Massachusetts plan or any plan you like. However, you don't get a state tax deduction unless you use the Georgia plan. That varies by state. Contributions are not tax deductible when you put in, so just like a Roth IRA, you don't get a deduction for putting in, but it does grow tax free if you use it for qualified education expenses. There are no annual limits to a contribution to an IRA, a 529 plan, but it is subject to gift tax rules. So if you go over $19,000 currently per year with a contribution, then you could be required to file a gift tax return, but not necessarily pay tax, just file a return. Limits for lifetimes vary by state, but they tend to be in that $300,000 to $500,000 range. So that's very large and much larger than most families are going to be required to put away for college. So for intents and purposes, for most people, you can kind of think of it as unlimited, or at least as much as you would care to do. The contributions are not limited by income. And I mentioned earlier they can be state tax deductible, but you just want to weigh the deduction versus the other plan. Like for instance, um, I actually have a 529 plan for my kids, but they are not, it's not in the Georgia plan. I did miss out on the state tax deduction, but Georgia's tax rate currently is only 5%. So it really didn't cost that much to do it in a plan that had a wider variety of investment options, which was the Rhode Island plan with Invesco, is the one that actually went with. 529 plan withdrawals are tax-free if you use them for education. So your growth, you'll never pay the child will never pay tax on the growth if it's used for education. Not just post-secondary education, but you can also take out up to 20,000 per year currently for kindergarten through 12th grade education. So think like private school or in expenses related to elementary, middle school, or high school. That is up from 10,000 the year before. So one of the new things in the new tax bill was to increase that to 20,000. If you have non-qualified withdrawals, meaning it's not for a qualified education expense, then just like the Trump account, it is taxed as ordinary income with a 10% penalty, but only on the earnings. So your contributions are still never taxed. So we like this a lot for education. If there's a certain amount of money, funding that's going to be needed for a child's education, 529 plan is hands down the best place to do it because you get the tax-free growth. You'll never have to worry about contribution limits or anything like that. And then the potential for the state tax deduction. If you overfund your account for a particular beneficiary, you can change the beneficiary to immediate family. And right there on the screen, we have what the definition of that is. As long as it's one of those immediate family, you can switch over to those. So you can move money around kind of interchangeably. If one family has, 3 kids and you want to just do most of the funding for the oldest one, knowing that what you don't use can then be shifted over to number two, and then what isn't used there can be shifted down to number three. That can be a good way to do it. And then whatever's left over, up to $35,000 total of unused 529 funds can actually be rolled over into a Roth IRA for the beneficiary, tax and penalty free. But that $35,000 is a lifetime limit, not an annual limit. And you still have to actually respect the annual limits for Roth contributions in order to do that. So it means is to get the $35,000 a year, you've actually this year's limit 7,500, so you actually got to do 7,500 this year, 7,500 the next year, and so on until you get it all moved over. So it can take you 5 years or more with growth to potentially get the funds moved over. So that can be a little bit of a hassle, but something to keep in mind that if you do accidentally overfund your 529 plan for a whole family, then there's something that can be done for that with that. So downsides, education only. Overfunding can be a little costly if you aren't careful with it, and the Roth contribution feature or conversion feature can take a while to get through. So similar to the Trump accounts, it has its own place and where it works best. Not great for retirement because of the penalty and the taxability if it's not used for education. Great for education, as we talked about, and it's not great for non education because of that same reason. So we like a lot of education, but it is a little bit limited in that regard. Another option is a custodial account. These are sometimes either called UTMA or UGMA. UTMA stands for the Uniform Transfer to Minors Act. UGMA is the Uniform Gift to Minors Act. Those terms are used interchangeably for the most part. These are custodial accounts that an adult holds on behalf of a minor. So think of it as legally owned by the child, but managed by an adult for the child, which is usually a parent, grandparent, or another family member. That happens until the child reaches the age of majority, which varies by state. In Georgia, it is 21, but the ownership can take place starting at 18. So what that looks like here is if you open a custodial account for a child in the state of Georgia at 18, the account can be transferred into the child's ownership. Then by 21, it must be. If it doesn't get transferred by age 21, then the account kind of freezes. It stays invested, but you can't add to it. You can't take money out. Really can't affect any transactions on that account until the ownership has been changed over to the what was the child who's now the legal adult. Kiddie tax rules may apply with this as well because the any income that is taxable within the account, like your capital gains, your dividend income, all of that flows to the child, but then goes to the parent's tax return, so it can end up being taxed at the parent's tax rate if it's over certain limits, which is around 2,000 or so per year. It varies in an index for inflation. So contributions are not tax deductible for this either. There are really no contribution limits, so that's a nice advantage. No income restrictions, so it's not like a Roth IRA where you can have too much income where you can't do it. However, those contributions are irrevocable gifts to the child, as we mentioned. So you really got to keep that in mind when you're making a contribution to one of these accounts. Is this an amount of money that I'm okay with this child having full access to at age 21? If not, then you can have a conversation about whether it makes sense to fully fund this or do it a different way. Because once they get that, they can use it for anything they want. And it's kind of the beauty and the scary part about these custodial accounts is they can kind of be used for anything. Before the age of majority, it's still has the requirement of being for the benefit of the child, but there's a very broad definition of that. At age of majority, it's their money and they can do anything they want with it. So there are no restrictions once transferred. So we have to keep that in mind. It's very simple, but again, the excuse me, I think I was on the wrong page. Okay. So disadvantages, there are no tax advantages to this. It's kind of like a regular investment account. It's just held for the child. The child gains full access at the majority, so there's no control, and the assets can actually negatively impact college financial aid eligibility for that child. So if a 18-year-old is looking to get a Pell Grant or something like that, then these assets can be taken into account to decide whether they qualify and could actually knock them out or knock them down based on the amount. So that's another thing to keep in mind. So what are these great for? Well, they're actually okay for early retirement because once the child takes possession of the money, it can be put away for retirement. It can be used to make Roth contributions or IRA contributions. It can be used for education. You can pay tuition out of it. There's no tax advantages for doing any of that, but it still can be used for that. It's flexible. There are no penalties. You can use it for a house, a car, business startup, whatever you want. It's really flexible. So that makes it a great all-purpose vehicle for that child. The more responsible the child, the better, of course. So that's just what we think we talk through quite a bit with our clients is, do you think the child's going to be capable of handling it? If not, there's some other ways we can still save for that child's benefit, but maybe that don't give the child full control. And even though we've got three right here, we think the Trump accounts are really best suited for getting an early start for retirement savings for the beneficiary. We think that the 529 plans are the best tool for education savings if we know that's going to be used for education. The UDMA accounts are kind of good for everything else. And we actually have one other idea or one other thought on that. And that is really there's nothing that says you can't just set money aside in your own account and earmark it for the child's benefit. So you can begin saving in an individual or joint investment account if you're married. Just save up there, let it grow. There are no tax advantages to that, obviously, either, but the gift of that account can be made to the child at different ages, whatever age you like. You can just use it to just write the check for college for them. So another way around that. So we have a lot of conversations with our clients about this and which one of these really four options makes the most sense. So with that, we have a little bit of extra time for questions. If anybody has a question, like Mike mentioned earlier, unfortunately, we're not able to use the chat feature. However, you can unmute your microphone and ask, or if you prefer, or if you think of something afterwards, there's a contact information above. You can shoot an email to the hello@tarrantfinancial.com, and we would be more than happy to get back to you on the question. So with that, any questions or thoughts on anything we covered today?
Charlie, while everybody's kind of thinking of some questions, wanted to run a couple by you as well. Just kind of circling back to the UDMA and the UGMA account there, and having to kind of navigate that kitty tax. Um, I think basically anything up to $2,500 is taxed at the kids' rate, which is hopefully not high if they're not employed.
Mhm.
What are some ways to invest money in those UGMA or UPMA accounts to kind of navigate the taxes there?
Yeah, that's a great question. So if you have money in the UTMA or UGMA and you're trying to keep the taxes low, one thing you would do is focus on growth-oriented stock investments, ones that are not going to be paying a lot of dividends but have growth potential because those are only taxable when you sell them. So if you hold those for a long period of time, you can have control over when they're sold, and then therefore you have control over when that growth actually becomes taxable. And so if that goes on long enough and you resist selling those investments until after the child is age of majority, no longer dependent, and those kiddie tax rules don't apply, then at that point the capital gains once those investments are liquidated would then fall on the child's who's now an adult's tax return at hopefully a lower rate. So things that are going to kick off the most income are going to be bonds and bond funds, which are ordinary income, your especially non-qualified dividends, which mostly are going to be international investments. Be careful about those because those are taxed as ordinary income as well. And then your qualified dividends are mostly going to be your U.S. stock investments. So really focusing on the assets that have higher growth and lower income would be the way to go on those.
So really, those are pretty open architecture, right? You could set those up at a fund company or at a brokerage account, or our custodian LPL, for example, can do that too. So in that case, you could even buy, tax efficient ETFs, kind of manage capital gains that way.
That's right. Yeah. So if they're open architecture, they're no limits. They're offered by most brokerage firms and broker dealers. So you can use ETFs, you can use individual stocks, you can use mutual funds, any of the above. But mutual ETFs would avoid those capital gain distributions that come out of mutual funds
Hmm.
as well. So yeah, that's a great idea.
Okay. So those can be managed to a degree there. Um, in thinking through, 529 accounts, you had touched on the convertibility to a Roth IRA, I think limited to $35,000 right over a 5 year period. So you kind of have to watch your earned income to do that. Um, what happens to the balance left in that 529 if they've converted their 35, but there's money left in there?
The options on that are you can cash it out and pay tax and the 10% penalty
Hmm.
on the earnings. So maybe not ideal, but
Yeah.
particularly if it's a small amount, that might be okay. You can change the beneficiary to another family member. Um, and then those are really your options.
Okay. Yeah.
I guess option three really would be you could hold on to it if you think you may have additional education coming in your future. At one point in the past, there was an age 30 requirement to have the money taken out of those, but that's been done away with.
Mm.
So you can actually hold on to it if you think that you may go back and get an advanced degree later, then you can keep it in your own name for that purpose, or a spouse or something like that.
Right. Okay. Yeah, I think it's worth noting we have seen several clients end up with money left in a 529, change the beneficiary, just kick it down to the next one in line. I believe you can also kick it up. We've had a client do that to go back to grad school. So there's some
Right.
flexibility on protecting the tax advantages through beneficiary changes there as well. And to Charlie's point about being careful not to overfund those, you have no idea what financial aid, right, your child or grandchild might get, or scholarship, for that matter. So we usually like the idea of striking a balance between these different tools. I think it's important to really kind of estimate what you think education might cost for your child or grandchild. We can model that with different universities and estimate what the cost would be and then develop a plan to divide that up between these different buckets. So just want to pay attention to that because you do have some options, but you got to watch the taxes on the back door of those things. Back on the Trump accounts, wanted to ask a question about that I got a feeling everybody's thinking but may not know to ask. Who controls the investments inside of those, and does the parent have any say in how that money is invested?
The investment options are very limited. I think, and this is since it's really not been very visible yet, I'm not 100% certain about whether there's going to be more than one or just one option. There may only be one option in the plan. If there is more than one, it may be two or three.
Hmm.
So the individual who's opening the account is going to have, for the benefit of the child, is going to have the visibility to all of that. But this is, if you don't have a lot of investment experience, this is not going to be a large burden on you or a big decision to make because they really tried to keep it simple. They want this to have long-term growth potential, so it's going to be a stock portfolio, and really it's going to be probably an S&P 500 index ETF
Hmm.
for the most part. And then so you don't have, there's going to be high growth. You don't have to worry about managing an asset allocation. And it's going to be, they want to make it simple so that anybody who logs in with no investment experience can get this set up for the beneficiary.
Perfect. Okay. Yeah, and that's something too. That's a good point. You want it to grow, right? That's the idea behind these things. So if you start it young, you want to see that compound over time. So I would suggest if anyone is logging in to open one of these and you're stuck on how the money's invested, let's just get together on Zoom or via email or text, and we can look at those options and see if it makes sense to go that route for your situation. Yeah, the idea is to do better there than in a savings account, right? Grow that for the future.
Right. Yeah. And the other thing I was mentioning is it is going to be 100% US stock investments
Hmm.
as well. So they definitely wanted to make sure to promote the home cook in there.
Yeah,
So, it may not be as diversified as a typical fully asset allocated portfolio, but it's going to have a lot of growth potential. And ideally, again, this is if you're opening this for a young child and the primary purpose is retirement, we may have a 50, 60-year runway on these accounts. So we don't really
right.
have to worry about being very conservative with that money. We can just try to get as much growth as possible.
And the fact that they will own it after 18, right, and it's convertible to an IRA or to a Roth is huge. So they could keep that going and control the investments after 18.
Right. Yeah. Love the Roth idea.
Okay. And there really aren't any restrictions on when they can Roth convert, correct? They basically could stagger that over their lifetime if they want to watch their tax bracket.
Oh, absolutely. Yeah. In
Yeah.
fact, what's probably the most common is to do when the child turns 18 is do a little bit, just depending on the income of the child and whether or
Hmm.
not there are kiddie tax rules. And if there are, then if that applies, then what's the income bracket of the parents? Maybe a little bit year eight when they turn 18, a little bit 19, a little bit 20, just kind of space it
Yes.
out to try to get this moved over as tax efficiently as possible into the Roth
Cool.
account.
That sounds great. Well, this has been great information, Charlie. Thank you very much. Before we sign off, everyone, any last call for questions from the audience? Anything top of mind you want to run through here for a minute? We have open mic.
And Open Charlie, that's a terrible pun.
Exactly.
Terrible
That's
joke.
another good pun there. Yeah. Tell us the end of the week over here
But
at Tarrant Financial.
yeah.
So, well, hey, thank you guys all for joining us today. We really appreciate your time. Hope this was very informative to you. If you think of any questions afterwards, shoot us an email. You can also text us at the main office number, and any of us can pick that up. And if you'd like to talk further about this topic, by all means, just shoot us a message and we'll hop on the calendar. Thanks again for joining us, and everybody have a great day.